in terms of market capitalization, this is as of 2018. Stock markets are huge. It was $75 trillion in 2018. It's probably closer to 100 now. Not all markets are as liquid. So, if you wanted to invest into, for example, the 100th largest company in the United States, that would be very liquid. For example, something like, let me look at a company that's around that size, not spending, investing. Palantir Technologies, that has a market cap of about $30 billion, and it has an average trading volume of 47 million shares, okay? Which is, at the current prices, it's over $700 million. So that's relatively liquid, okay? If you want to see a rather liquid market, let's look at Google. And average volume is 38 million shares, but Google is trading at a much higher price. So we're talking about over $5 billion a day trading volume. So which one do you think is more liquid? Google or Palantir Technologies? In one of them, average trading volume is about 5 billion, the other is 700 million. So if you wanted to get rid of a position of $500 million, which one would be easier? Google or Palantir Technologies? Google trades $5 billion a day on average. Palantir trades about 700 million a day. It will be Google, because if you're going to dump $500 million worth of stuff, the market's trading 5 billion. We can actually do that without affecting the price too much. But if you try to dump $500 million worth of Palantir in one day, that stock's price is going to go down quite a bit. Think about, for example, let's look at the depth of the buy and sell orders. Let me see, there should be another kind of chart. Okay. For example, in terms of buy orders, from 115 to 125, there is about $38 billion worth of buy orders, okay? Or from 120 to 125, it's about $21 billion, I'm sorry. Let's look at Palantir Technologies. Current price is about 14. It's $14.72, between $14 and $14.75. There's about $1.7 billion demand. A little bit better, $1.1 billion demand. So if you wanted to dump $1 billion worth of stuff, you can dump it, but price would go down from $14.72 to $14.50, which is quite a bit of a drop. If you look at Google, let's look at where 1 billion is. Or 1.7 billion roughly. No, 1.1 billion. Somewhere around here. Yeah. If you dumped $1 billion worth of Google, the price only would go down from about 125 to 124.75. So you affected the price by only 0.2%. With Palantir, you would have affected the price over 2%. That's what we mean by liquidity. Okay. So liquidity is a desirable property in an investment, because anytime you want to get out, it shouldn't cost you in terms of price impact. US markets are obviously much more liquid compared to foreign markets. Developed markets are much more liquid. So German market would be more liquid than market in Taiwan or China. And such liquidity makes those markets more desirable. So in general, valuation of companies in more liquid markets are going to be higher. Because consider two companies that are otherwise the same. One is trading in Taiwan, the other is trading in US. Which one would you buy? You would buy the one in US because it's a much more liquid market. It's not going to cost you that much money to get out. That means, the valuation in US is going to be higher. Now, benefits from diversification is not going to be as high if those foreign markets are concentrated. If you look at here, it gives an example. The largest 10 companies on the Budapest Stock Exchange, which is Hungary, accounts for over 95% of the total market cap of the stock exchange. So if you're investing into Hungary, you're basically investing into those 10 companies. On the other hand, if you look at US, for example, let me see. Let's look at S&P 500. Or let me see. Vanguard total stock market. This is a total stock market ETF from Vanguard. Let's look at the top 10 holdings in terms of assets. It's only 26%. So in US, top 10 firms are only 26% of the market. In Hungary, it is 95. Let's look at Japan, for example. There's a Japan ETF by MSCI. Let's see. 24%, top 10 holdings. Germany ETF. Uh, 56%. So German stock market is a lot more concentrated. Or let's look at UK ETF. Or British ETF, I should say. EWB maybe? Is there no ETF for England? Oh, there you go. United Kingdom. Let me see. 52%. So there is also a lot more concentration there. Let's try one more country. ETF China. let's do large caps only. Again, 56%. So other than US and Japan, there is actually a lot of concentration. And that doesn't even look for the cross holdings. Because in places like Germany, markets are organized around some big companies. They have a lot of subsidiaries, so they own shares with each other. So even without that, those markets are concentrated. You can read all of that stuff. Okay. Now, in terms of trading in international equities, unless you're managing a large investment fund, you would not directly invest in country. Okay? If you're managing $1 billion that's allocated to, let's say, emerging markets, and you want to buy some stocks from Turkish stock market, you actually would go contact some brokers, and you would buy it and sell it directly from them. But if you want to do this for your own portfolio, let's say you want to invest $10,000 into German stock market. One alternative is to individually research German stocks, decide which German stocks to buy, but cost of that for a small US investor is pretty high. Okay?